Why are they only getting a 6 times ARR multiple? Because they're only growing at 20%. Now, sorry to anyone affiliated with Nutanix, but I have to lead with this metric. Zscaler reported Q2 numbers recently, and the metric that jumped off the screen at me was... So not quite sure what investors are seeing in Zscaler to justify a 16 times ARR multiple. So we saw a 20% share price dip post Q2 earnings, and that was largely driven by... But the thing that you're going to want to keep an eye on here is, can they hold off that ARR growth deceleration? Welcome to episode 28 of the SaaS Report. I'm your host, Matt Aird. And today we're going to be looking at Q2 numbers from Figma, ServiceTitan, Zscaler, Elastic, Nutanix, and GitLab. So a lot to get through. Just before we get into the episode today, just a heads up, the Q2 State of SaaS Report for 2025 will be out within the next 10 days as I record this. We've got all of the data in right now. So if you want to see the data in its raw form, you can get the Q2 State of SaaS data sheet. So that breaks down 42 companies across 15 core SaaS metrics. If you want to wait until the full report is out, that's going to be ready in the next couple of weeks. And there we'll look at the trends in these metrics over time by these companies. We'll do some comparisons across different data sets and try to paint a picture for where SaaS sits in the current landscape. Right, so that'll be out in the next couple of weeks, but let's get into today's episode. So we got Q2 numbers from Elastic and they were solid. Nothing spectacular, but pretty good. 20% ARR growth, 260 million in net new ARR year over year, and 107 million in net new ARR quarter over quarter. They spent $161 million on sales and marketing in the last 90 days to generate that growth. So that gives them CAC payback of 22 months. Now, when you hear that number, right, if you're sitting in a kind of private, early stage, fast growing SaaS company, that 22 months doesn't sound that good. But when you're a public SaaS company north of $1 billion in ARR, that's actually pretty good, right? So the median for a public SaaS company that we track at the moment is about 28 months, right? So they're well below that mark. Efficiency was good as well. So they had 25% free cash flow margins, negative 2% operating margins for the quarter. And the median across all of the companies that we track is 20% for free cash flow and negative 3% on operating margins. So they beat the marks there as well. Other headlines from their Q2 numbers: Rule of 40 came in at 45, Rule of X at 65, and ARR per employee at 418,000. Right, so what do we have here? We've got a SaaS company kind of performing above the median across kind of all of the core SaaS metrics with a market cap of about 9.5 billion, right? So that gives them a ARR multiple right now of about 6 times. Right, so just 6 times ARR multiple for a company kind of beating the benchmarks across the kind of the median of the companies that we look at, right? And why is that? Why are they only getting a 6 times ARR multiple? Because they're only growing at 20%, right? They've done a good job holding off kind of ARR growth deceleration over the last few quarters. But when you've got these kind of AI native companies out there at the moment, mostly in the private markets, yes, but when you've got companies that are growing, 200-300% per year, 20% ARR growth just doesn't feel that impressive, right? And so what we're seeing is the ARR multiples for these kind of middle of the road SaaS companies compress, right? So that kind of thing is out of Elastic's control, right? They can't control that. They can't control the multiple that their stock generates, but they're producing good numbers. So good, solid Q2 from Elastic. Now, sorry to anyone affiliated with Nutanix, but I have to lead with this metric. Nutanix, you had CAC payback of 142 months in Q2 this year. 260 million in sales and marketing spend for only 25 million in net new ARR. Now, when we zoom out, this metric becomes much more respectable. So over the last 12 months, they spent about $1 billion on sales and marketing. They generated about 389 million in net new ARR. So that gives them CAC payback over the last 12 months of 37 months, right? Much more respectable, and some really good efficiency improvements for them year over year. So gross margin is up to 87% from 85. Operating income came in at 5% versus -2% a year ago, and net income was up to 6% from -23% a year ago. Even growth rate was up, so they posted 19% ARR growth in Q2 this year versus 13% in Q2 last year. The improvements in efficiency was mostly driven by a reduction in sales and marketing spending. So sales and marketing spend as a percentage of revenue was cut from 47% down to 43% in Q2 of this year. And if we zoom out, they were spending as much as 54% of revenue on sales and marketing in Q2 of 22. So this has been kind of steadily decreasing over the last couple of years, but we do see a slight uptick here over the last 2 quarters. Other headline stats for Nutanix: Rule of 40 came in at 51, Rule of X came in at 69, free cash flow margin came in at 32% for the quarter, and they're trading at a market cap of about 21 billion, which is about 8.3 times Q2 ARR. Zscaler reported Q2 numbers recently, and the metric that jumped off the screen at me was actually nothing, right? The quarter was very meh from Zscaler. Now, they're a company that's trading at the higher end of ARR multiples. They're getting a 16 times ARR multiple at the moment, right? With a market cap of 47 billion. Now, when we look at other companies around a similar run rate, right, we can see that Zscaler is trading at a pretty significant premium, almost 2 times the rate that, HubSpot, Monday, and GitLab are trading for. And honestly, I can't see a good justification for it. So they grew 21% year over year to 2.9 billion in ARR, adding 505 million in net new ARR year over year. GitLab and Monday are growing faster, and HubSpot isn't too far behind when we look at ARR growth rates in Q2. And Zscaler reported CAC payback of 38 months. Again, kind of much worse than HubSpot, Monday, and GitLab, who all reported CAC paybacks under 30 months in Q2. Right, so maybe it's an efficiency thing, right? Not quite hitting the mark in ARR growth rates, behind on CAC payback. Maybe it's free cash flow margins that's driving kind of the differentiation here. But when we look at this chart, right, Monday has a better free cash flow margin, and admittedly Zscaler is kind of outperforming GitLab and HubSpot here, but probably not by enough to justify the premium they're trading at. Operating margin for Zscaler improved slightly, so from -5% in Q2 last year to -4% this year. Rule of 40 came in at 45, Rule of X at 67. ARR per employee came in at 362,000. That's well below the median across the companies that we track, which was 416,000 in Q2. So not quite sure what investors are seeing in Zscaler to justify a 16 times ARR multiple in today's environment, but maybe I'm missing something obvious. Let me know what you think it might be in the comments. Whenever you've got NRR above 120%, you're doing something right, and that's the position that GitLab has found itself in pretty consistently since becoming a public company. We did see some slippage here over the last couple of quarters, so down from 126% in Q2 last year to 122% in Q2 this year. Growth was strong as well, came in at 29% year over year. That's well above the 19% median for the companies that we track in Q2. They added 214 million in net new ARR year over year and spent about 400 million on sales and marketing over the last 12 months to generate that growth. So that gives them CAC payback of 26 months. Saw some pretty good improvements in operating efficiency as well. So operating margin came in at -8%, right? Not amazing, but a significant improvement on the -22% operating margin they posted in Q2 last year. This came about due to pretty big cuts in all 3 of the major kind of OpEx spend categories. So sales and marketing spending was down to 46% of revenue from 54% a year ago. R&D was down to 30% from 34%, and G&A was down to 19% from 24%. Some other headline stats for GitLab: Rule of 40 came in at 49, Rule of X came in at 78, and magic number came in at 0.80 for the quarter. RPO, they posted 988 million in remaining performance obligations, and that was up 32% year over year, which is outstanding. So really good quarter for GitLab. They're trading at just under 9 times Q2 ARR right now. ServiceTitan is a new addition to the basket of companies that we track in our State of SaaS Metrics series. For those of you that haven't come across them before, they're a vertical SaaS platform. They help trades-based businesses, so think, plumbers, HVAC contractors, roofers, right, electricians. They help these kinds of organizations manage their operations. Were founded in 2007, went public in December of last year, so pretty long kind of gestational period for them, right, in the private markets. 17 years from founding to IPO. They're at about 930 million in ARR right now, growing 26%, so pretty good. They added 191 million in ARR year over year, spending about 265 million on sales and marketing to generate that growth. So that gives them CAC payback of 21 months, magic number of 0.72, and NRR is strong for them as well at 110%. But operating margin, so operating efficiency, leaves a little bit to be desired. That came in at negative 14%. Their G&A expense seems high to me, right? That's coming in at 26% of revenue. For companies that we track at around about $1 billion in ARR, we typically see this much lower, right? GitLab is at 19% of revenue. Monday's at 13%. Box is at 13%. Confluence at 14%. So pretty high spend on G&A for ServiceTitan. Other headline stats, free cash flow came in at 14% for the quarter. So rule of 40 at 40%, rule of X at 66, and ARR per employee, not great at 229,000. They've got a market cap of 10.7 billion, or about 11.5 times Q2 ARR. We got the first quarterly report for Figma in Q2, and after a pretty volatile first few weeks as a public company, we got even more of that post the Q2 earnings announcement. So we saw a 20% share price dip post Q2 earnings, and that was largely driven by a, I guess, lower than expected kind of revenue forecast for Q3. So they're expecting ARR growth of 33% in Q3, which is down pretty substantially, right, from the 41% ARR growth they posted in Q2 this year, right? But digging into their results for Q2, they added 290 million in net new ARR year over year, 86 million in ARR quarter over quarter. That gave them pretty crazy go-to-market efficiency in Q2. CAC payback came in at 11 months. Magic number came in at 1.25. If we zoom out a little bit though and look at these metrics with a 12-month view, they're a little bit more subdued. So last 12-month CAC payback came in at 23 months. From an efficiency standpoint, they're ticking all of the boxes. 25% free cash flow margin, 1% operating margin, which is good, right, for a company at $1 billion. ARR per employee is exceptional, so 606,000 in ARR per employee. So a decent start for Figma, but the thing that you're going to want to keep an eye on here is, can they hold off that ARR growth deceleration, right? We've talked about it for the last few weeks. Every SaaS company faces this at some point, right? It's very hard to defy gravity. ARR growth rates will decline at some point. Figma is going to want to hold those kind of north of 30% for as long as possible. So that's going to be the metric to watch for them moving forward. Thanks for tuning in this week. I'll see you here again next week with a few more updates from our Q2 State of SaaS report. Again, if you want to grab any of that data, I'll link to those reports in the show notes. Thanks for joining me this week. I'll see you again next week. Until then, goodbye.